Is the graph dead, or is this the single most asymmetric risk-to-reward setup in the entire infrastructure sector? We're looking at a token that has retraced 98% from its all-time highs. It has given back every single cent of the gains from the 2024 cycle. For most investors, this chart looks like a graveyard. But when I overlay the on-chain data with the current market structure, I see something very different. We are sitting on a razor's edge, a support level that dates back to the token's launch in 2020. If this holds, the technical upside is massive. If it breaks, we enter price discovery to the downside. Today, I'm going to show you exactly why I'm adding to my position right here, despite the fear, and the specific invalidation level that would make me cut the trade immediately. Let's be honest about where we stand. The price action on GRT has been frustrating. If you have been following the channel, you know I have been trading this asset for years. I accumulated heavily back in late 2022 at around 5 cents. We rode that wave up to 49 cents in March of 2024, a 780% move. I took profits. I did everything right. But now, we are back at square one. The price is hovering between 3 and 4 cents. It feels like the market has completely forgotten about this project. And I know many of you are confused. You look at the partnerships, you look at the utility, and you ask, why is this bleeding? Part of this is macro. Bitcoin dominance has been the absolute king of this cycle, draining liquidity from everything else. Even altcoins with perfect tokenomics are suffering. But with the graph, there is a specific concern about profitability. We are seeing expenses outpacing revenue, which we will discuss in a minute. However, the sentiment right now is peak capitulation. When I check the social metrics, it is a ghost town. And for a contrarian investor, that silence is often the first signal to pay attention. We are back in the accumulation zone I marked out last videos. But simply being cheap is not enough. We need a catalyst. And there's something happening in the fundamentals that suggests the market is pricing this wrong. Let's look at the actual business underneath the token. There are two major stories here that the price is currently ignoring. First, the Horizon upgrade. This was a massive technical overhaul for the protocol, and the data shows it was a complete success. 100% of active indexers have moved to Horizon. 99% of all queries are now served through this new system. We are talking about 668 million queries served in just 10 days. This eliminates the execution risk. The network is scaling, and it's stable. But the bigger story, the one that hasn't been priced in yet, is the pivot to artificial intelligence. The graph has historically been known as the Google of blockchains for DeFi data. But look at their recent communications. They are explicitly positioning the protocol as the infrastructure layer for AI agents. They are indexing structured blockchain data specifically for machine learning models. Why does this matter? Because the AI agent narrative is the hottest sector in crypto right now. Institutional money is looking for infrastructure plays that support autonomous agents. The graph is effectively re-rating itself from a legacy DeFi coin to a core piece of the AI tech stack. However, we have to address the elephant in the room, the earnings. When we look at the token terminal data, the protocol has net earnings of negative $25 million over the last 365 days. They are paying out more in incentives to indexers than they are collecting in query fees. This is the bearish argument. It's a subsidized growth model. Investors are currently funding that burn rate. But here's the counterpoint. Despite the price crash, the holder count is moving up and to the right. We have over 173,000 holders. The users are not leaving, only the speculators are. This divergence, price down, participation up, is a classic accumulation signal. Now, let's pull up the weekly chart. This is where the trade setup reveals itself. We are looking at a massive falling wedge pattern that has been forming since 2024. This is traditionally a bullish reversal structure, but you have to trade it carefully. Right now, the price is sitting exactly in my green accumulation box, between 3 cents and 5 cents. We are testing the lower trend line of this wedge. This level, 3 cents, is critical. This was essentially the launch price back in 2020. It is the absolute floor. If we lose 3 cents on a weekly close, the structure breaks, and we could see a catastrophic drop. That is why I say this is a line in the sand.
Now let's look at the moving averages. It's ugly. We are below the 10, 21, 55, 100, and 200 exponential moving averages.
In fact, we just got a hard rejection off the 10 EMA on the weekly timeframe. That blue line acted as dynamic resistance and pushed us back down. This tells me the bears are still in total control of the momentum. However, the oscillators are telling a different story. The Heikin-Ashi RSI below is deep in oversold territory. We are seeing the kind of compression that usually precedes a violent move. If we can bounce from here, we have a very clear roadmap of resistance levels. First, we need to clear 5 cents. That is the top of the falling wedge. A weekly close above 5 cents confirms the breakout. Next is the descending trendline from the May 2025 highs, which comes in around 9 cents. Then, we have the point of control on the volume profile, the VRVP, at 10 cents. This is a magnet for price. A lot of volume was traded there, and price likes to revert to the mean. Above that, we have the confluence of the 236 Fibonacci level and the long-term descending trendline from 2021. That sits around 14 cents. So, the levels are clear. Support is 3 cents. Resistance starts at 5 cents. The gap between them is the opportunity. So, how am I playing this? I'm treating this as 2 separate buckets. I have my long-term moon bag that I accumulated years ago. I'm not touching that. I'm not selling at these lows. However, I'm also adding to my current short-term trade. You may ask, why? Because the risk-to-reward ratio is mathematically perfect. As I explained in my last The Graph video, I'm adding between 3 and 4 cents. My stop loss is tight. If we get a confirmed weekly candle close below 3 cents, or basically a bit below that liquidation wick from October, I am cutting this short-term position. I'm not interested in holding a bag that is entering price discovery to the downside. But if the wedge plays out, my targets are structured. I'll take a small profit at 5 cents to cover fees. My main targets are 10 cents, that point of control, and then 18 cents. If the market goes parabolic and the AI narrative really catches fire, I have higher cycle targets at 30 cents, 49 cents, and the moonbag target at 77 cents. This is a probability game. We are betting on a bounce from a historical support level within a bullish chart pattern, backed by a protocol that just successfully upgraded its entire network. So, the graph is in a do-or-die moment. The financials are concerning, but the utility is undeniable, and the chart is screaming deep value to anyone brave enough to look at it. I'm taking the bet, but I'm keeping my stop loss strict. If you want to see exactly when I pull the trigger on these trades, or if I get stopped out, join my private community on Telegram. It's free. The link is in the pinned comment below. We are tracking this market 24/7. Also, if you want the full backstory on how we traded this in the past, go watch my video from December 29th. It gives you the complete context. Link on your screen. Remember, none of this is financial advice. I am just a guy reading the charts and researching the best alpha every single day. I really want to help you. Keep your risk managed, and I'll see you tomorrow in the next one. Cheers.